It's certainly a very emphatic affirmation of faith in the leadership of Prime Minister Narendra Modi. And of course, it's a continuity of leadership that is being affirmed. But the fact of the matter is that it's also a mandate for doing big reforms. So it's not about continuity in that sense. I mean, this is a mandate that provides the opportunity to do big, bold reforms, and we know that Prime Minister Modi is not shy of doing so.
Absolutely. We are also talking at a time when we are seeing a big slowdown. Everybody is talking about how auto sales are coming down. There is a consumption issue as well. Firstly, in your view, since you are here in North Block, you have, you're speaking to a lot of stakeholders. Is there a slowdown? And if there is, how is the government looking to tackle it?
So, there has been a demand slowdown. Now, external demand, as you know, has been erratic for many years now. But domestic demand had actually held up, despite many opinions to the contrary. For many years, domestic demand actually held up quite well. But in very recent months, last 3-4 months, it is true that domestic demand too has slowed down. It's a point that actually a finance ministry note that we put out publicly also mentioned. So it's not like it's something we highlighted ourselves. And yes, so we do need to begin to think about this demand slowdown. But the good news is there is fair amount of leeway and things we can do, simply because inflation is so well controlled, and there are many areas now, especially with a clear political mandate, we should be able to deal with it.
Is there a case for a fiscal stimulus for the economy?
Well, I cannot presume to speak for a new government which hasn't been sworn in, so it will obviously, the new leadership will have to take a call. But there is space in various directions, I mean, including in the monetary side, a point that I have made many times, both on liquidity and on real interest rates. But there may be things to be done on the fiscal side. But I would argue, given the time space there is, this may also be a good time to do serious structural reforms, and I think we'll come back to that later in the interview.
Yeah, absolutely. Since you were saying that there are a lot of things that can be done on the monetary side, I mean, if you could help us understand what is it, in which direction can we see policy making happening in the next few days to address the issue of slowdown?
Well, I have to be a little careful here because it is really the mandate of the Monetary Policy Committee. So all I can really say is that there is space, a point I have made before. So I'm not saying anything new on the monetary side, both on liquidity and rates. And a point, again, as I said, I have made for a long time, that real interest rates in India may be too tight given how low inflation has been now for a very long time. So inflationary expectations would have by now significantly come off from what they used to be in the old days.
Has RBI's single-minded focus on inflation costed us growth?
I think one has to be a little careful about that. I mean, the fact is, let's go 5 years back. What was the issue? The issue was that we had a serious macro instability, and so they were given a mandate which was clear, an inflation targeting mandate, and they have delivered on it. So let us not be unfair to them. They were given a clear mandate, and they have delivered on exactly what they have to do. Now, the point is that having achieved that, that gives us space to do other things. So let us not throw the baby out with the bathwater. I mean, they have been successful in doing what they were set out to do. Inflation has been well controlled, and that's a good thing.
But when you say perhaps this is the time that there is a need to relook at the entire inflation targeting regime, how would you, look at that?
No, I think this inflation stability has been hard won. I wouldn't tamper with it casually. Fact of the matter is that many people say that, the inflation band is too tight, etc. Well, we have actually, that would be a problem if we were continuously hitting the top of the band and we needed some more space. In fact, we have only once been outside the band and it's to the downside, and for a good proportion of the time we have been in the lower half of the band. So I don't think the band itself is in itself the problem. But we need to also take a wider view on liquidity and real interest rates, etc. But I would be very, very careful of throwing the baby out with the bathwater. The thing that this framework was set out to do has been hard won. This success in controlling inflation, the first time in pretty much generations perhaps we have inflation so well controlled. So I think having taken the pain of lowering this, let us not tamper with this.
You were talking about liquidity issues that are there in the economy, and one of the sectors that is hard hit because of the liquidity issue is the entire NBFC space. Fitch in one of their reports said that this is a part of the larger shakeout. We will see more consolidation happening in the NBFC space. How are you looking at what's happening with the NBFC sector? Is there a case for tighter regulations there?
Certainly in a broader sense, there is a case for paying more attention to regulating the NBFC sector without overdoing it, because the NBFC sector does fill a certain spaces that the regular banks don't. But nevertheless, it's quite clear that their asset liability mismatch issues, and especially when they become systemically large, do need to be supervised much more tightly. Now, for the specific episode that we are currently having, while I can't comment on specific companies, let it be said that as a general principle, regulators and the government should not interfere too much in the evolution of of what goes on in the private sector. Otherwise, what's the difference between us and having a control economy? You have to allow the private sector to sort of work itself out in various ways. However, we do recognize that there is a systemic issue as well. So should a largest institution or institutions have problems and create wider credit market effects, and we did have one episode like that with ILFS, if you remember, back in September. So in those situations, then obviously the authorities do need to step in and play a role. So
but otherwise the government will keep a hand.
As a general principle, that should be the general principle. As I said, when there is a systemic jamming up of freezing up of the credit market or whatever other things that may happen, then yes, making sure that the system remains. Now, in the past, liquidity windows have been used, various coordination efforts have been done in order to keep the wider system from freezing up. So if necessary, I'm sure the central bank and the government will come together and do whatever is necessary. The matter is being watched very, very carefully. But if I had to take a cricketing analogy, which is very popular in this country, the referee and the groundsman cannot interfere in the match. We have to watch the match and let it play itself out. Every time, one side for whatever reason has a collapse of wickets or something, we can't suddenly stop the match.
Absolutely. Let me shift focus then and talk about and get back the focus on growth once again. 3 out of the 4 engines in the economy are down. I mean, look at what's happening with consumption, exports, as well as the larger economy as well. What is it that needs to be done? How do you re-engineer the economy in such a way that it stimulates investment, it stimulates private investment, which has not been coming in for some time now?
So I think for that we need to think about the bigger picture, particularly what a government should do. Now let me clarify here, a new government has not been sworn in, so I cannot presume to speak on its behalf. I'm just saying as an economist what should be done. Now, what were the last 5 years all about? The last 5 years were about doing the following things, and it's important to understand, then you'll see the contrast with what I think should be done. The last 5 years were about, first and foremost, imposing macroeconomic stability, because that was what was inherited. The next thing was last mile delivery of services to the poor. So many kinds of services you saw, last mile delivery of that. Third, creating a framework of infrastructure, that is basic infrastructure, so that the economy can function. And this is not just of the last government, it's an accumulated effort of several governments. So by and large, now I can say that the airports are reasonably decent, and we have a decentish network of them. Our highway system is not too bad. We can improve on it, but it's reasonably good. In fact, bits are international quality. The railway system is beginning to upgrade itself, and so on and so forth. Our telecoms networks and so on. So our infrastructure is not the binding constraint anymore, which was, say, a decade ago. Then we have done some major framework reforms. One is GST, Insolvency and Bankruptcy Code, and a bunch of others. So what we have, this was what was...
So we build on a...
Yeah, so this was what the agenda, so to speak, was of the last 5 years. Creating frameworks, whether it's for last mile delivery or of infrastructure or for governance. The next 5 years, as I would say, should be about emphasis on growth, particularly driven by exports and private investment. So as I said, this is a somewhat different tack. It required the previous lot to be done in order to be able to do this, but now the space is open for going for growth. So, and as I said, specific kind of growth. I at least am not in favor of artificially inflating consumption. Obviously we are happy that Indians consume more and so on, but we have got to be careful of artificially inflating consumption, because we cannot then complain that savings rates are falling. Our savings rate also needs to go up. Then we need a financial system that can take this savings and invest it. This is sort of what East Asia did during its high growth phase. We should be willing to take some version of that model and be able to. And incidentally, during the 19th century, the Europeans were doing pretty much the same thing. Early 20th century, the Americans were doing the same thing. So this high savings, high investment, export-oriented approach to growth, I think we should pay attention to this.